There are a lot of investors who use managed funds almost exclusively, and there's nothing at all wrong with that. But where it makes sense, we prefer investing directly for a couple of reasons. Firstly, it keeps the costs down, and secondly, it allows us to pursue the sorts of investment themes we've been talking about, and that's worked well for our clients in the past. But we're not sanctimoniously opposed to managed funds. In fact, we're certain that there's a place for them in most investment portfolios. And that's because some investment themes are almost impossible to implement directly. For example, most of the time we're keen for our clients to have some exposure to smaller companies. And this is especially so at the moment. We mentioned earlier that large companies on the market are all survivors and their balance sheets have never been stronger. This puts them in a really great position to expand in future. But if the economy stays tough and organic earnings growth is elusive, they could well choose to grow through acquisition. We could see some takeover activity, and this will boost the value of smaller company shares. Overall, the smaller companies index isn't that much more volatile than the index for larger companies. But individual investments can be quite risky, so you need to give yourself plenty of spread. And there are a huge number of smaller companies to choose from and very little easily accessible information to base decisions on. For all of these reasons, using a good quality fund manager for smaller company exposure is a really good idea. The solid green bars show the performance over a number of different timescales for the median of the fund managers who invest in the total Australian market. You can compare those results to the broken green bars that show the return from the index, the ASX 200, over the same periods. Fund managers generally seem to have covered their fees plus a bit when compared to the index. The solid blue bars show the performance of the median of the smaller company fund managers, and this performance can be compared to the broken blue bars representing the Small Ordinaries Index. The median fund manager has substantially outperformed the index over all of the periods shown, and this indicates that clever people who know what they're doing can take advantage of the information inefficiencies in the market and add real value. There's also a strong argument for having some international fund managers in your portfolio. Don't turn off. Let me tell you why. It's really pretty simple. If the world grows faster than Australia and the value of our dollar falls, you won't get the full benefit by simply focusing on Australian companies with an international footprint. For long-term investors, this may be a really difficult pill to swallow. The performance of almost all international funds has been appalling for over 10 years. The tech wreck was worse overseas than it was here. The global financial crisis was really the North Atlantic financial crisis. We've had the chance here to ride the commodities wave, and the value of our currency has doubled. All this has made making money overseas really, really difficult. You just need to be wary of rampant retrospection. Australian companies aren't better managed than companies overseas. Our governments of either persuasion are no better than governments overseas. And as a nation of people, we're not smarter or more talented or better looking or even better at sport than people overseas. We're just really, really lucky to have done as well as we have, and the really, really smart money knows it. Since 9/11, investing directly overseas has become more difficult and definitely more expensive than investing locally. And anyway, there are tens of thousands of companies out there to pick from, and choosing what to invest in is almost impossible. If there was ever an argument for using a fund manager, it's to do your international investing for you, and fortunately there are some really good fund managers out there to choose from, and they're not all that expensive. So here's a couple of tips. Don't buy an index fund. Europe's going to be really tough, and Japan has demographic issues that are as big as their national debt, and that's big. You'll get a load of Europe and a load of Japan in an international index fund. And don't buy a hedge fund. The hedge funds have done better in recent years when the value of our currency has been going up, but if the Australian dollar is likely to fall, you actually want exposure to other countries' currencies.